While everyone was watching Bitcoin's price tick up and down on a 15-minute chart, Google quietly dropped a research paper that didn't make the trending tab, didn't get a 3-hour Twitter space, and wasn't the top story on any crypto news desk. And yet, what that paper contains is the single most important development in blockchain infrastructure in the last decade. Not because it signals a bull run, not because it means XRP is going to $100 next week, but because it sets a countdown clock on the cryptographic security of the two largest networks in the world. And that clock is ticking faster than anyone in the mainstream conversation is willing to admit. The number on the clock, 9 minutes. Let me explain exactly what that means, and why where you are positioned right now could not matter more. Welcome back to Ledger.Wealth.Network. I am not here to sell you a price target or tell you what to buy. I am here to do what we always do. Go underneath the surface of the news cycle and map the structural reality that drives the market years before retail ever sees it. This is not financial advice. This is a forensic breakdown of what Google just published and what it means for the networks that survive. Let me start with the hard truth that most of the commentary on this story is completely missing. When people talk about quantum computing as a threat to crypto, the instinct is to wave it off. It's 20 years away. The developers will just patch it. Don't panic. I've heard every version of that argument, and I want to be precise about why it fails when you apply it to what Google actually published. Google's latest research, flagged and highlighted by Project 11, shows a 10x improvement over the best previously published quantum attack benchmarks. They have reduced the qubit requirement for breaking elliptic curve cryptography, the mathematical backbone of Bitcoin and Ethereum's security, down to between 1,200 and 1,450 logical qubits, depending on architecture. That number has dropped dramatically faster than the field predicted. Here's what that means in plain terms. The algorithms that protect your private key, the string of numbers that proves you own your crypto, are based on a mathematical problem that classical computers cannot solve in any reasonable time frame. Quantum computers operate on entirely different physics. And Google just demonstrated that the threshold where quantum breaks classical cryptography is not 2040. They are setting a working estimate of 2029. That is 36 months from today. Now here is the specific mechanism that makes this catastrophic for proof-of-work chains specifically, and this is the part most people skip over. When you send a Bitcoin transaction, it does not confirm instantly. It enters the mempool a publicly visible waiting room, where it can sit for minutes before a miner picks it up and includes it in a block. During that window, your public key is exposed. It is visible to every node on the network. Bitcoin's average block time is 10 minutes. Google's research shows a quantum computer deriving a private key from an exposed public key in approximately 9 minutes. Do the math. A quantum attacker sees your transaction in the mempool, derives your private key in 9 minutes, constructs a competing transaction that redirects your funds, broadcasts it to the network, and your original transaction never settles. That is not a theoretical exploit. That is a specific, timed, documented attack vector with a clock that fits inside Bitcoin's own block window. For Ethereum, the vulnerability is different but equally severe. Ethereum wallets that have ever sent a transaction have their public key permanently recorded on chain. Google estimates the top 1,000 Ethereum wallets holding billions in value, could be compromised in under 9 days. These are not edge case wallets. These are the wallets that move markets. This is the foundation. Everything else we discussed today is built on top of it. Let me show you the math that the crowd is ignoring, because the numbers here are not just alarming in isolation. They become catastrophic when you map them against the scale of the assets involved. There are currently 1.7 million Bitcoin held in what are called pay-to-public key scripts, P2PK. These are addresses where the public key is permanently exposed on-chain, not just during a transaction window, but at rest, permanently. That includes a significant portion of early mining rewards from the Satoshi era. 6.7 million Bitcoin total has been identified as vulnerable to at-rest attacks, where a quantum computer does not even need to wait for a transaction. The key is already visible. At today's prices, that is over $600 billion in Bitcoin, sitting with its lock exposed in a world where the lockpick is being actively engineered on a published 36-month timeline. Now let's talk about what this means for the networks positioned on the other side of this equation. The XRP ledger processes transactions to finality in 3 to 5 seconds, no mempool. Transactions do not sit in a public waiting room. The attack window that Google just measured at 9 minutes does not exist on the XRPL. The architectural design of the consensus mechanism eliminates the exposure window before it can be exploited. But here is where the math gets structural. Ripple has been managing a $27 trillion opportunity in the Nostro Vostro correspondent banking system. Cross-border payments represent $150 trillion annually. The foreign exchange market turns over $7.5 trillion every single day. These are not future projections. These are current flows that the global financial system needs to route today. And routing them on infrastructure with a known, timed, published quantum vulnerability is not a risk any regulated financial institution can accept. Here's the supply side. XRP has a fixed cap of 100 billion tokens. Circulating supply sits in the range of 55 to 57 billion. Exchange reserves are tracking at multi-year lows according to on-chain forensic data. Monthly escrow releases of 1 billion tokens have seen the majority relocked. The liquid float is shrinking. The addressable opportunity is expanding, and the security premium attached to quantum-resistant infrastructure has not yet been priced into the asset. This isn't a prediction. It is a structural requirement. If the market has to route $150 trillion annually through compliant quantum-hardened rails, and the float capable of bridging those flows is contracting, you do not need a crystal ball to understand what the next variable in that equation resolves to. While the retail crowd is processing Google's paper as a scary headline and moving on, ask yourself what the institutions are actually doing. Ripple did not acquire Hidden Road, a prime brokerage firm clearing over $3 trillion annually, as a marketing exercise. That is infrastructure acquisition. That is a firm that understood years in advance that the future of cross-border settlement requires a compliant, scalable, post-quantum hardened network. You do not spend at that level unless you have regulatory certainty and technological confidence locked in. The Digital Asset Clarity Act, currently moving through the U.S. legislative process, is designed to formally classify assets like XRP as digital commodities under CFTC jurisdiction. That is not a rumor. That is a structural legal gate that, when it clears, removes one of the last institutional compliance blockers from the largest pool of managed capital on Earth. The pension funds, the custodians, the sovereign wealth managers, they are not holding back because they lack conviction. They are holding back because their legal teams require clarity before the infrastructure commitments go live. Now layer the Hedera picture on top of this. Hedera's governing council includes Google, IBM, Dell, Deutsche Telekom, Standard Bank, Nomura, and 44 other global enterprises. These are governance commitments, not sponsorships. These are entities that evaluated Hedera's ABFT consensus, its quantum-resistant architecture, its regulatory compliance posture, and said, "We will govern this network." That is the due diligence list that institutional infrastructure decisions are made from. And Hedera's Hbar, which today trades around 10 cents, is classified as a digital commodity by both the SEC and the CFTC. It is post-quantum secure since its first day of operation, not retrofitted, not patched. Designed from inception with quantum resistance in the foundational cryptographic layer, smart money does not wait for the mainstream conversation to catch up. Smart money positions before the narrative shifts. And right now, the narrative has not shifted yet, but Google just lit the fuse. Here is where the timeline compresses, and I want you to understand why the next 18 months are the window. First, the Digital Asset Clarity Act is expected to reach a vote in 2025. When it does, it removes the single largest compliance barrier for US-based institutional allocation to XRP. The firms that have been waiting are not going to trickle in. They are going to allocate. That is not a prediction. That is how institutional gate opening works. Second, the 2029 quantum timeline Google published is not the moment the threat activates. It is the estimated completion point. The intermediate milestones, incremental qubit improvements, architecture refinements, will generate their own market-moving signals before the full capability arrives. Each one will force the quantum security conversation higher on the institutional priority list. Third, spot XRP ETF applications are in motion. When approval lands, it opens the retail and institutional access layer that currently requires direct custody. That dramatically expands the addressable demand side for an already contracting float. The window between today and when these catalysts converge is the window the informed investor uses. Once regulatory clarity drops, once ETF approval lands, once the quantum timeline compresses another 12 months, the price will already reflect it. By then, the accumulation phase will be over. The door is closing. It is closing slowly enough that most people cannot feel the draft, but it is closing. Let me be clear about something that is not being discussed. Every informed investor who understands the Google quantum timeline and understands the Nostro Vostro addressable market and understands the regulatory pathway, every single one of them is looking at the same contracting float, the same institutional positioning, the same shrinking exchange reserves. The question is not whether the market re-rates quantum resistance. The question is what price XRP and Hbar are trading at when it does. Because once the re-rating begins, the retail window closes fast. The liquidity that allows for quiet accumulation at current prices disappears the moment the narrative is mainstream. Right now, the narrative is not mainstream. Right now, you are reading between the lines of a Google research paper that most of the market has already scrolled past. That is a position of advantage. The only question is whether you use it. Let me leave you with this. Google did not publish a scary headline. Google published a technical blueprint that puts a verified expiration date on the security foundations of the two largest crypto networks on Earth. And in the same moment, it revealed that two networks, XRP and Hbar, were built from the ground up to survive exactly this transition. XRP moves the money, Hbar moves the assets. Both do it on infrastructure designed to outlast the quantum era that is now 36 months from confirmed capability. Price is noise, structure is signal, and the structure is telling you that the security premium on quantum-resistant networks has not yet been priced in. In a market fueled by emotion and noise, we thrive on data and composure. Haste leads to loss. Calm analysis leads to victory. I am Ledger.Wealth.Network. The math doesn't lie, and the clock is running. Comment quantum below if you made it to the end. I want to see who is actually paying attention.